Dan Davis, ADK Wealth Advisory Group, talking to you on this wintry March 1st, 2019 day from the front of our office. Many of you have never been here, so I thought I'd give you a flavor of where we're at. So you can kind of see behind me the highway, that's Highway 6440. We're cut in the western part of the city, and it's very wooded out here and very suburban living. So since you may never come, I thought I'd let you see what it looks like, and if you do come to join us, you'll be able to see a little bit about what we see. Have a great day. So I'm speaking to you today from ADK Wealth Advisory Group, St. Louis office in the lobby, so you'll have a little bit of background noise, but since many of you have never been here, I thought sharing with you where we entered the building might be a little interesting as you sort of think about if you were coming to the office in the future, what it would look like. The theme for 2019 is late cycle is not end cycle. So as I think about past videos, what you've heard me say is that the market cycle and the economic cycle, that if we make it to the summer of this year without a recession, it'll be the longest economic cycle we've seen happen growth-wise since post-World War II. Not necessarily the most robust, but the longest. And you've also heard me say that the likelihood of a recession this calendar year is very low. We would repeat that. We would say that the window between, say, mid-2020, end of 2021, and that window is where current data would say that that's the most likely spot for a recession. So if we kind of downshift and we take a look at economic news, there was an article in the Wall Street Journal yesterday, and it summarized the U.S. economy last year. It says U.S. economy grew 2.6% in the fourth quarter. A year of strong economic growth in 2018 ended on a soft note, with the nation's economic output slowing from boom-like conditions at mid-year. I think they probably overstated boom-like conditions in mid-year, but definitely we are at the point where we're growing, but at decreasing growth rates. If you go across the pond and you look at Europe, they're growing at a much slower rate than us. Italy, I would say, is probably in recession. Germany is skidding a little bit because they're such a big exporter, and their two biggest clients, US and China, are in the trade negotiations. If we stay in the world of economy, but talk more like 2019, our expectations would be that the US would grow 2.5. Most of what I read says that global growth will be above 3. I find it hard to believe that most of what I've seen says 3.7. I think high 2s to low 3s is what I would expect. When I think in terms of what do we really look at for you to make sure that our forecasts are reasonable, economic news, corporate earnings, valuations. If I take a look at corporate earnings, last year we saw the first 3 quarters have 20% plus earnings growth on the S&P 500. We saw the fourth quarter more like around 14, and we expect 2019 to be more like 10 to 12. So again, it's growing, but at a slowing rate. And I think that can go on for a while. Our expectations on returns would be that we think that we can see what we made up from last year that we lost in the fourth quarter, plus adding on another 7 to 10%. We are currently, if you look at the S&P 500, above where we entered December last year, but not where we hit the peak in the fall. Valuations on the S&P 500, if you said what's trailing 12 months, it's 20. That would be at a premium compared to history. History is about 15.5. I would say, though, that the current earnings and where we're at in the cycle would support 18 to 20. If you looked at PE a year ago, it was at 25. To me, that was high. If you take a look at what is the forecast for the next 12 months with earnings and current stock price, it's at 16, which I think is low compared to what it should be. Shifting from economic news and thinking more in terms of the bond market. When I take a look at the bond market, as you've heard us say, we believe that interest rates are rising, but that they'll rise in sort of a choppy fashion. They'll go up, they'll come back down, go up, come back down, but rise over time. That is in play. The belief for this year is it's one of those where it's going to come back down and plateau for a little while, so we think bond rates will be in the positive returns this year. And when I kind of shift from the bond market to the last topic, our team attended a Barron's Team Summit. 200 teams attended this, and they bring in industry leaders talking about where's the industry going. And my two big takeaways: one is that technology is important to be able to utilize to serve you best. So there's going to be some things that we add on this year that will allow us to do that. For example, adding Zoom, which is a technology that allows video conferencing for those of that you want that. We'll keep Glance, that allows you to see our desktop share without video if that's preferred. And then lastly, which is kind of more important than that, is where we really see the industry going is serving in teams, which we already do right now, but we believe that the teams are going to be bigger than what they are. Right now you see a lot of independent teams of 3 to 10 person, where I think it's going to be 10 years from now is that you're going to have regional teams that maybe you'd have St. Louis, Nashville, Charlotte, etc., Denver, where you've got 20, 30 people in each location. So researching that, trying to figure out what that means, could require us to merge with other firms. I'm not interested in that, like eager to merge, because it is a behemoth task, but if it's what's necessary to be able to serve you properly, we're very interested in that. So bringing it back into market update, if I were going to summarize, again, just to reiterate, late is not end. Just wanted to say thank you very much for your time today. Thank you for your business. Appreciate referrals. Last year, many of you referred people like yourself who were interested in bringing 5 to 6 clients on a year. When it's appropriate, the best way to do that is send them to our website, discoverindependence.com, and then also ask if it would be appropriate if you could email me their contact information. I'll then email our bios and stuff like that, follow up respectfully so that it's appropriate. So signing off from the St. Louis office lobby, thank you for your time. Take care.